we know that current situation in UAE and overall GCC is not actually favorable, and things are going on, but we all probably feel safe over here. The only reason to still continue with the webinar was uh, that I needed to pass on the message that we are positive, and I needed to pass on the positive message that come what may, we are going to work and we are going to move forward as it is, because on ground level, everybody is attending, and who are from UAE, they know that on ground level we are probably very safe, and the things are moving on quietly, and due to Ramadan also only few fasting left. So due to that, anyways, last 10 Ramadan, there is a slow work in the UAE market. So nothing to worry about, like as such. Things are going on, and we hope that situation will improve in further days, and we would be back to the track. Yes, there's a short term thing in the market where their correction is happening due to panic, but this is the right time. If you have good investors, to invest money in UAE, because you might be getting very good deals out of it. People who are in panic will sell, but long term investors are not willing to sell because they see the perspective from 5 years to 10 years of their investment, so they don't sell basically. So let's hope for a very good future ahead, and be positive in whatever field you are and however you are working. Be careful talking to the investors, and hope for the best. So let's start. So coming to, as we marketed ourselves, that the basic purpose of this webinar is that there are lots of real estate agents, consultants over here, and Indian investors over here as well as in India, who invest in UAE, specifically Dubai. But what happens is that they don't know the compliance rules of India. Maybe the chartered accountants are not guiding them. For real estate consultants over here, it is good to have a knowledge of the same thing, because while conversating with your client, when he's asking the questions regarding some compliance rules of India, you should have the answers. Because if you'll have the answers, then you are winning the trust of the client. And once you win the trust of the client remains with you for the lifetime. So let's start our webinar for today. We have covered many things in this webinar. One by one, we have covered residential status, we have covered TCS, LRS, ODI routes, which can be very helpful to Indian investors as well as real estate consultants. So next, Abdul, next. First thing, when a client comes to you for investment, you need to know what is his residential status. If he's staying in India, you need to determine whether he's a tax resident of India or a non-resident Indian. You need to determine that, because your advice is based on whether what is the residential status, and based on that you can tell him how much money he can bring from India to UAE. So first important thing is residential status. Next, before buying property, your residential status matters the most. Why? I'll tell you. Because what happens is, when you are an Indian tax resident, when your client is an Indian tax resident, irrespective you are selling UAE, that UAE is tax free, UAE is tax free. I know many of my friends, real estate friends, are saying there's no tax in UAE, there's no tax in UAE. But if your client is investing from India, if he's investing from India, there's no tax over here. I understand. There's no tax on rent over here because there's no personal income tax over here. There's no tax over here for selling the property gains. When, for an example, you bought a property for 1 million, you are selling from 1.5 million. The 500,000 dirham is the gain. There's no tax in UAE for that if you're doing it on individual basis. But in India, because you are an Indian tax resident, your income gets taxed in India. This you should tell your client properly. So, because your residential status decides where you pay tax and where your foreign income is taxed. Next. It's a very simple thing. I'm not making it complicate because the complication regarding determining a residential status should be handled by a chartered accountant or an expert. But for basic knowledge, you should know few things. First thing is, where does your client stay? In India, in UAE, or some other country? First thing. If he stays in India, whether he is staying in India for 182 days or more, if yes, if he's staying in India for 182 days or more, he becomes an Indian tax resident. There are other conditions. One more condition is if he's staying in India for more than 60 days in that year, and previous 4 years he has stayed in India for more than 365 days, still he is an Indian resident. Okay. So what happens is you need to know where are you staying and how many days are you staying. There is an exception to the 60 days rule, which I'll cover in the next slide. If you go through the example right now, for an example, Mr. Arjun. Mr. Arjun stayed in India for 80 days and residential status in India is determined by financial year. And financial year in India is 1 April 2001 from 1st April to 31st March. So for an example, if we talk about the financial year right now, from 1st April 2025 to 31st March 2026 is one financial year in India, that is called financial year 25-26. As soon as 31st March ends, the next financial year starts. It's called financial year 26-27. So Mr. Arjun stayed 80 days in this year. This year means we can say in the financial year 25-26, and 400 days in last 4 years. I am talking about staying in India. Since both limits are crossed, he is an Indian tax resident. And what happens if you are Indian tax resident, we will cover in next slide. But talking about the exception, next slide, please. There is an exception for non-resident Indians, means people who work abroad, who go from India, they are going for on salary basis to other countries. The rule of 60 days and 365 days is not applicable. You have to see only one thing, whether you are in India for 182 days or more. If you are staying in India for 182 days or more, you are an Indian tax resident. But because you have gone for a job, obviously depends on date when you left India. 182 days, if you have stayed less than 182 days in India, then you are a non-resident. And once you become non-resident, many things become easy for you. Let's see an example. Sarah works in Dubai and visits India for 4 months. She is still a non-resident. Why? Because 60 days rule is not applicable to her, and she works in Dubai and she is out of India for more than 182 days. It's almost like 6 months. Next. This is a very important point. What happens is, because you are you all I believe that my audience majorly is real estate consultants, and basically when they are selling the property, because I'm watching it closely because I have been guiding my investors as well in real estate. So what I see is that everybody is selling UAE real estate as a tax free thing. And as I said before, yes, it is tax free. If you are buying on your individual name, it is tax free because there is no personal income tax in UAE. But when you are talking to a Indian client, specifically I'm talking about Indian client, whether he will be taxed in India or not depends on his residential status. So if he is a Indian income tax resident, the global income, all over the world income would be taxable in India because he is an Indian tax resident. But if he is a non-resident, only Indian income is taxable in India. Rest all the income is taxable in that specific country. So if you are working in UAE, there is no personal income tax. So what happens is that whatever salary you are earning in UAE, it is not taxable in UAE, and it is not taxable in India as well if you are a non-resident. But for an example, your client is working in other jurisdiction, for an example, USA, UK. their tax laws will be applicable to them. So based on the residential status, it is determined whether it would be taxable in India or in that foreign jurisdiction. So non-simple rule it is that if you are an Indian tax resident, all over the world income is taxable in India. But if you are not an Indian tax resident, only income from India is taxable in India. Rest, all the income is taxable in that specific jurisdiction. For an example, UAE there is no tax, that's why not taxable. But USA there are taxes, so it is taxable in USA. Next, let's take an example here. Rahul lives in London and buys property there. Will India tax his UK rent? Again, determining the residential status. If he is a non-resident, India cannot tax it. But if he is a resident, yes, taxable in India. So, residential status decides whether foreign property income is taxed or not. Why we are giving so much emphasis on residential status is because based on residential, this is the first point. Based on the residential status, your next consulting or your next things determined. For an example, I am dealing with a client. I am dealing with an Indian client, but he stays in UAE. First thing I talk with him when he's talking about real estate investment is what is your residential status? Are you staying in UAE or you are staying in India more? Once I determine that status, then I guide them in further things. Why you will come to know because you will also get that knowledge. We have prepared it for you specially. So you'll come to know that. Next, please take it before you. Before investing abroad or selling property, always check your residential status because one wrong assumption can change your entire tax liability. Because if you are an Indian tax resident, you are exposed to FEMA rules, Foreign Exchange Management Act. You have to follow that. You are exposed to Indian Income Tax Act. You are exposed to LRS rules you have to follow. You are exposed to TCS rules. If you don't follow, see when you are when your client is transferring or when as an Indian investor you are transferring money from India to UAE, bank will stop you on the TCS basis. But apart from that, all the disclosure things and everything needs to be done, which nobody is guiding. So what you need to do is you need to tell your client if he is an Indian investor, sir, you can invest here. It is free. It is easy. You can invest properly through bank. That is also okay. TCS provisions. That is also, we will explain you what is TCS. That is also okay. But sir, you need to do the disclosure in India. Because what happens is first clients buy the property here. People sell it that yes, UAE accepts everything, this, that, everything. But what happens is when the notice comes from Indian authorities, usually investors get angry. But thing is, imagine you are a good real estate consultant and you are from the first step you are telling your client, sir, this is your exposure, this is your exposure. Plan your investment properly. What will happen is that client will value you, will value your knowledge, and then whenever he is investing, he will never ask for any other real estate consultant. He will definitely come and meet you. Why? Because in the first step you guided them very honestly and correctly and you saved them from all the compliances and legal issues in India. Next, what is LRS? So first thing what we determined is what we need to determine is whether the client investing from India or anywhere around the world who is an Indian is a non-resident or a resident. If the client is non-resident, rules of LRS are different. If the client is resident, rules of LRS are different. Let's understand what is LRS. LRS means Liberalized Remittance Scheme. This is legal way for Indian residents to send money abroad. RBI, Reserve Bank of India, regulates this. It says that it allows residents to transfer money outside India for investments, buying property, education, travel, and gifts. It allows them. So India, if your Indian client is having money in Indian bank, he can transfer it from Indian bank to other nations' bank as well as per liberalized remittance scheme rule given by the RBI. Next, LRS is applicable to resident Indian. That's why we were discussing what is resident and non-resident. So any Indian tax resident needs to follow LRS, Liberalized Remittance Scheme. Now, what happens in Liberalized Remittance Scheme? Let's discuss that. Next. Under Liberalized Remittance Scheme, Indian tax resident or an Indian investor can invest $250,000 per year out of India. And it is total, means the total yearly limit is combined from property, investment, education, gift. For an example, Indian investors Indian investor's son or daughter is studying abroad and he has already transferred $100,000. Now his limit is left 150. You cannot say that for property my limit is 250, for investment, different investment my limit is 250. The limit of $250,000 per financial year. And as I said, financial year in India is from 1st April to 31st March. In that particular one financial year, or you can say $250,000 per year if he is an Indian tax resident. Now, what do usually people do? That because, for an example, property is costly, and you need to transfer, for an example, 2 million in a year. What they do usually, they have three names in the property, and each and every person has the limit. So from the family, three names, they do it like that. Legally structuring. I'm not giving you any guidance which is not as per the law, because if you give any guidance to the client which is not as per the law, you make sure that today or tomorrow your client will land in trouble. So always follow the legal limits, always follow the compliances, and because of your client following all the compliances, even you are spared of the extra headache when the notices arrive. And it doesn't mean that Indian income tax authorities or Indian government agencies wouldn't uh, give notices even if you are doing the investment legally. They can, but if your records are right, if you have followed all the rules, there's nothing to worry. You just need to give a reply. This is my funds. This is how it was transferred, and everything is okay. So you don't need to. You need to have that fear that clients usually say that when I invest legally from India, the authorities in India trouble me. It is not a trouble. If you are investing legally, there is no trouble. You just need to give them answer, prove the sources, prove everything, disclose everything, and you are okay. Next, LRS cannot be used by non-resident Indians, companies, firms, LLP, trust. If client lives in Dubai and qualifies as NRI, LRS does not apply, means they must use NRE, NRO banking route, not LRS. Now let me explain you what is this. First thing is, as we were discussing, resident and non-resident. Once your client is resident, we follow LRS, so that thing is done. For an example, your client is not a resident taxable person of India, so he's a non-resident taxable person. First thing, when you are a non-resident taxable person, the Indian rule says you cannot have a savings bank account in India. So what do you have in bank account in India then? You have a NRI bank account. NRI bank account consists of two parts. One is called NRO, that is non-resident, a non-resident operative account, and another is non-resident external account. Now let's divide this NRO and NRE. NRO means India, NRE means dollar. You can say NRO means INR, NRE means dollar. So whenever your income is generated in India, that amount goes in NRO account. And when you want to transfer that Indian amount to other jurisdiction, other country as a NRI, you transfer that money from NRO to NRE. So your INR becomes dollar or dirham. Simultaneously, if you are staying in UAE, you want to send money outside India, want to send money outside UAE to India, you transfer your money from NRE, you have your bank account over here. For an example, your bank account in Emirates NBD, and you have an Indian bank account, NRI bank account, ICICI. What you do is from your Emirates NBD, you transfer to ICICI NRE account. Now that is also still it is a foreign income. Even though amount is gone in ICICI account, still this is a foreign amount. This is in dollars. From that NRE, once you transfer it to NRO, it becomes a Indian rupees. Vice versa, from India to UAE, NRO to NRE, from UAE to India, NRE to NR. This is the route which NRIs need to follow. Let's take an example. My client is staying in UAE, is a non-resident Indian working over here on salary. He sells one property in India, for example, 2 million dirhams. 2 million dirhams, he has sold one property in India, around 5 crore Indian rupees. He has paid all the taxes and now he has 4.5 CR to be transferred over here. Okay, whether he can do it or not. First thing, he can do it, but not by LRS route, but by NRE, NRO banking route. Now, the money goes in NRO banking, NRO account, and then from it comes to NRE, and then from it comes to Dubai. Now, what happens is, how much is the limit? As Indian tax resident, the limit was $250,000. For NRIs, this limit becomes $1 million. So $1 million, you can imagine, $1 million is like almost 3.5 million dirhams in 1 year from NRE, from NRO to NRE. This is what is the benefit of becoming a non-resident. And yes, the property purchased over here will not be taxable in India because your client is a NRI, and whatever rental income is earning from here, it is also not taxable. Only Indian income would be taxable in India. And you can say your client is having any Indian income. For an example, is having a rental income or maybe a capital gain income, whatever. They have to just mention that in their income tax return and it's done. Regarding other properties held outside India, they don't have to declare. Next, we are seeing here the case study. Amit lives in India and wants to buy a Dubai apartment worth 700,000 dirhams. Whether he can buy? Yes, he can buy. Why? Because $250,000, the limit is almost 917,500 dirhams. So if the Dubai apartment worth is 700,000 dirham, he can easily transfer. Client wants to send 1.5 million to Dubai in 1 year. Not allowed in 1 year. What is the another option to do that? Send in multiple years. Now what happens is, right now we are sitting in March. Last week I was having a discussion. I'm giving you a live example. Client said that I want to transfer almost like 1.7 million. I said, as per LRS limit, you can't do that. I said, but because we are sitting in March, the financial year gets over. You transfer $250,000, which is almost 900,000 dirhams this month, March, and transfer next month 900,000 dirhams. So legally, you are complying with the Indian law because financial year changes after March. In one financial year, you are allowed. So this financial year, you are sending this 900,000, and next financial year, you will be sending. So you are legally complying with the Indian laws as well as you are getting the money over here. So this is how the advice works, and this is what you need to be aware of while guiding the Indian clients. Now, many of them might be having a question that what if there is a big amount? How do they invest? How do bigger players invest? See, bigger players are already having an existence in other countries with companies over here or companies in Mauritius or companies in UK, US. So they don't usually they don't invest on the individual name. They usually invest on the company name or maybe on the family trust name, which is a different tax structure and very technical. So the big amount moving over here always comes by, you can say, company to company. And basically they have all the presence in all other countries as well, all other region as well. So they tend to move the funds from there where they LRS limit, and Indian moving money from India is a challenge, but moving money from any other jurisdiction is not a challenge. And they, because imagine a client doing a 10 million, 20 million deal, and I think 99% of the clients who are capable of doing 20 million or 30 million as an investment, they just don't have presence only in India. They have presence in Singapore, they have presence in Mauritius, they have presence in UK, US, like that. So what happens is it becomes easier for them to move the money from that jurisdiction and directly invest in Dubai. NRI mistake. Client lives and works in Dubai, says I'll send money under LRS. It cannot be done because LRS is only for residents and not non-resident Indians. Next. Again, for this is just an important slide for my real estate friends. Before advising any client who is buying property abroad, always check whether he is a resident or a non-resident. If he is a resident, LRS applies. If he is non-resident, LRS doesn't apply. So non-resident, if he is a resident, he will transfer via LRS $250,000 per year. Non-resident will follow NRE NRO route. $1 million per year is the limit for that. Next. Now what happens is if you are an Indian tax resident and if your client is an Indian tax resident, what they need to do in their Indian income tax return, they need to disclose. Who needs to disclose? Indian tax resident. It doesn't matter whether property is purchased from foreign income, purchased from savings abroad, taken loan, gift from your friend staying in other jurisdictions, other countries. If your client or if you as an investor are Indian tax resident, irrespective of how you have purchased the property, how you have moved the funds, you need to declare that in your Indian income tax return. Non-declaration has penal consequences. Next. See, this is just an example. It is very technical. Chartered accountants usually understand this. It is just given for example basis. What needs to be disclosed? And foreign assets in Indian income tax return, it needs to be disclosed. Which country, zip code, address of the property. Are you a direct owner or a beneficial owner? Date of acquisition, total investment in INR, whether any income derived, what is the nature of income, and schedule where offered and number of schedule. Means how where you have offered this income and everything you need to disclose. What happens is that once you disclose, it means you are showing authorities that I have a property, Indian authorities, I have a property abroad. I am just made it for investment. I am not earning any income from it, or I have a property abroad and I am earning income from it and I'm disclosing it here and I'm paying taxes on it. If your client does this, if you as an investor do this, no authority can trouble you. It's just a compliance. Next. What happens if you don't report? There's a penalty. If your client, that's why. Now, this is a very important point. What happens is everybody needs to understand this. Penalty under Black Money Act. Black Money Act, why? Because you are hiding. If your money is legal, if you are investing legally, then you need to disclose it. If you are not disclosing it, means authorities say that your money was not legal, you have not invested from the legal sources, and that's why This is undisclosed income and it comes under black money. Now, when I say money is not legal and legal, it doesn't mean that your client or you are earning the money from illegal sources like betting, gambling. I am saying legal and illegal in the sense when the money is recorded in the books, it is through a banking structure, it is called a proper legal source money. But when it is in cash, which is unaccounted money, irrespective of from where the money is coming, that unaccounted money becomes illegal money in the and because it is not in the books, it becomes black money. That's why Black Money Act is imposed in India, and only if even if you forget to disclose, the penalty is 10 lakh Indian rupees every year, and the prosecution risk is different. Uh, Only to disclose, this is the penalty if you forget to disclose. Next. But your client is non-resident, then what happens? If non-resident, no need to disclose foreign property, not applicable. Only Indian income needs to be reported in Indian income tax return and that. So it's a very good benefit of becoming a non-resident, and many of my clients basically structure their taxes in such a way. You might have listened in the news as well that XYZ is moving from UK to here, that person has moved his jurisdiction from India to UAE. Why they do this? They do this to become non-resident so that they can avoid that complex taxability or taxation which is happening in India, and they feel that this jurisdiction is safe. And you can say in UAE there is only 9% corporate tax on business income. In personal income tax, there is no personal income tax over here. So if you are earning salary, there is no income tax over here. If you are earning rental income, no income tax over here. So usually what happens is UAE becomes the attractive destination. This geopolitical tension is only a part. You can say this time will pass. Once again, when the things become normal, you will see that it would again be booming like before, and it would be a bounce back basically. So those who are listening to me, those who are working in UAE, staying in UAE, I feel this is an opportunity to be in UAE, specifically be in UAE, because now you know that you are working only with serious people who choose to stay right now also due to this situation. So these are the people who have the trust in this land, in this government, and people like you and me who trust this government, trust this land, trust how the leaders are operating over here. Again, it will bounce back, and when it bounces back, I think sky is the limit. And you can see the trend of UAE 2008, then COVID, then again you can see floods, and now everything you can see the trend. UAE always bounces back. So there's no point of writing off UAE, specifically Dubai. And I'll be saying that this is an opportunity. Be positive in the market, and you will see the differences. Yes, there is panic selling, but we have panic sellers in the market. So we have good investors who want to buy in this market. Even I am in conversation with many of them who want to buy in this market, not run away from the market. So there are different types of investors in all over the world. Few are worried in panic situation, and few are opportunist. So opportunists are coming over here. You need to target opportunists and give them a good deal, and you would be surviving very well in UAE. Next. Let's see an example. Mr. A is a non-resident Indian. He's staying in UAE, bought apartment in Dubai from UAE salary, no Indian funds used. No reporting required in Indian income tax return. But if Mr. A status changes from non-resident Indian to resident Indian, means Mr. A now has a property in Dubai, but now he is gone to India and he has decided that Mr. A will stay in India. From now on, he's moved back to India. He becomes an Indian tax resident. Now Disclosure becomes mandatory that at the time when I was having a salary, I purchased all this property and I'm declaring this, and whatever income is generating from that property, that would be taxable in India once residential status changes. Till the time you are non-resident, the residential status is non-resident, it is not taxable in India. Next. See this. This is a table prepared for you. And yes, guys, if you have registered through email, we would be sending you this document. And at last, once we complete our presentation, we will be taking question and answer also. So, resident versus non-resident, let's see. If you are an Indian tax resident, foreign property disclosure is mandatory, non-resident Indian, not required. Schedule fixed assets means in income tax return you need to show the fixed assets of other jurisdictions. Yes, non-resident, not applicable. Even if no income from foreign property, if you are resident, then also you need to show. In NRI, you don't need to show. Penalty risk. Indian tax resident have a higher penalty risk. Non-resident Indians don't have a penalty risk, basically. Now, what happens is that why we are discussing this resident, non-resident, schedule FA, this all because this comes with the consequences. So now till this point of presentation, you might have understand why residential status is so much important. And now you would be thinking that if client becomes a non-resident Indian, it becomes very easy. Yes, of course, it becomes very easy, but it's not possible for everyone to become a non-resident. So it's better who doesn't become a non-resident, you can guide them on the compliances side. Next. This is very important. This is very important because what happens is many of my real estate, I have many friends in real estate, and many of my friends ask me that client is saying that there would be 20% tax. I cannot send money from India legally because there's 20% more. No, 20% is not a tax, not a expense. It is a tax which is called an advance tax. How it is how it is managed, we will explain you. First, that 20% means tax collected at sources. For an example, I need to send money 1 crore Indian rupees from India to UAE. It's like 400,000 dirhams. From India to UAE, 1 CR would be transferred here and 20 lakhs would be deposited in Indian Income Tax Authority's account, which is called advance tax. If I don't deposit, this money wouldn't get transferred because bank will stop you. Because LRS, TCS comes hand in hand and it is done through bank. You go to bank and tell them I need to transfer money. For an example, there's a Soba developer over here. The Indian goes over there. He says, I want to transfer this money to Soba developer, and it is almost like 1 CR Indian rupees or 400,000 dirhams. Bank will say, okay, go to your chartered accountant, bring form 15 CACB. Once you go to a form chartered accountant for bringing form 15 CACB, chartered accountant will say, okay, your funds are clear, everything is okay, but the rule says that unless you deposit 20% in the government account, I cannot issue you the form 15 CACB. 15 CA can be issued, but 15 CB is signed by an Indian chartered accountant. He will not sign it. And if it doesn't sign it, your money doesn't get transferred. So what he'll do, he'll say, pay the money, give me the proof, or he will pay it on behalf of you. You transfer the money to a chartered accountant, he will pay in the government account. Once he has the proof, then only he will sign the 15 CB. You go to bank with both the forms 15 CA, CB, give it to the bank. Then only bank from your account will transfer the money to foreign bank account. So this is the rule basically. I have said this in my on my social media as well. This is the rule basically. So what happens is the client say no, 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 I cannot transfer money from Indian account because I would be it is expensive. It becomes 20% more. No, this is a cash flow problem. This is not an expense. For an example, I am an Indian tax resident. I am having money in India and I am transferring money from India to UAE from my personal account and I am transferring 1 crore. Now 20 lakhs is deposited in my Indian income tax account, which is my advance tax. Now what happens is that while I am filing my Indian income tax return, keeping all my Indian income and global income in my Indian income tax return, my tax payable comes to 5 lakhs, but I have paid 20 lakhs. So Indian authorities will refund me that 15 lakh rupees in my bank account as soon as I file the return. Within 15 days, 20 days, my return is processed and I receive that extra money. So what happens is this is a cash flow problem. For an example, I am invested money in December in UAE. The Indian income tax government took that money of 20 lakh rupees from me in December. My return filing comes in May, June because year ends in March. And I file it in June, I receive the money in July. So Indian government, Indian income tax department is using my 20 lakhs from December to July. This is a cash flow problem, not an expense problem. This you need to explain it to your client. Next. As I already discussed, it's not a tax, it's not a penalty, it is just advanced tax collection. You can adjust or claim refund later. Think as government is holding some amount temporarily. Next, already I have discussed this. You can adjust your total tax liability or you can claim refund, or and it appears in the forms in Indian income tax return. Those who know Indian income tax return would be knowing the meaning of form 26 AS and AIS, but your chartered accountant needs to know. You don't need to know about all this. It's okay. Next. Already I have discussed the example, but let's see this example. Mr. Arjun sends 40 lakh abroad for investment. Bank collects TCS at 20%, 8 lakh. During the income tax return filing of Mr. Arjun, the total tax payable is 6 lakhs. And he has already paid 8 lakhs as advance as TCS. So 2 lakh he will get a refund. But if filing during ITR, his tax payable is 10 lakh because already 8 lakh is paid, he will pay 2 lakh extra. So TCS is adjustable and it is not a permanent cost. Next. When does TCS apply? It applies to Indian tax resident. Sending money abroad means anywhere. We are, because we are sitting in UAE talking about UAE, talking about Dubai. That's why we have taken examples of Dubai. If a residential individual sends money abroad to buy property in Dubai, pay booking amount, pay installments to foreign developer, TCS applies under LRS, Liberal Remittance Scheme, and the rate is 20%. And already we know the limit, $250,000. Next. Mr. Samir books apartment in Dubai. Resident means Indian tax resident. Remittance 50 lakh, TCS 20%, so it becomes 10 lakh. So what happens is Mr. Samir's pocket, you can say money would be out of 60 lakhs, 50 lakhs will come to Dubai and 10 lakhs will go to Indian income tax department. Next. So what are the key tax takeaways for residents regarding TCS? It is not an extra tax. Whenever you are dealing with your Indian clients, imagine if you are saying, sir, this is not extra tax. I have the knowledge. I'm telling you, sir, this is adjusted against your advance, against your tax payable. Imagine the impression which you are putting on your client. Imagine the way client will react to you. He will trust you because you have the knowledge. He will trust you and he'll say that my real estate advisor, even sitting in UAE or maybe in India or maybe in any other jurisdiction, he has the knowledge of Indian income tax laws, Indian laws. So this you can say the knowledge which I am sharing today, which we are sharing today, it's for every real estate agent sitting in Dubai, sitting in UAE, and dealing with Indian clients. It doesn't matter what is your nationality. Your nationality of your client is important. If your client is an Indian investor, and imagine you having this knowledge regarding LRS, TCS, regarding the taxation, and giving them guidance regarding residential status, non-residential status. If you hold the conversation like this, then imagine the impression which you are putting on your investor and how much impact it would have on your further relation. Whenever that client will invest, will definitely be investing with you, and you would become their portfolio handlers. This is what happens with us as a chartered accountant. We manage the portfolios of many of our clients just because we have this knowledge. Next, does TCS apply to non-resident Indian? The answer is no. Why? Because LRS, Liberal Remittance Scheme, is applicable to residents, not non-residents. NRI transactions are governed under Foreign Exchange Management Act. Yes, they are governed under Foreign Exchange Management Act, but related to NRE and NRO accounts. Since LRS does not apply, TCS does not apply. If LRS applies, TCS applies. It is a simple rule. Next. Resident sending money abroad, TCS applies. Non-resident sending own funds, no LRS, no TCS. Next. This is very important. We have put it in slides just because we have already discussed this, but while you would be going through the slides when we'll be sharing you this as a copy, it would be very important for you. That's why we have prepared this. Let's understand. Indian tax resident having rental income from UAE property taxable in India. Why? Because it is a global income is taxable in India. What about non-resident? Not taxable. Capital gain on sale of UAE property means your client is having a gain for selling property in UAE. It is taxable in India because Indian tax resident global income is taxable. Non-resident again not taxable in India. What about UAE? Because there is no personal income tax in UAE, no capital gain tax in UAE, non-resident wouldn't be getting tax in UAE. Disclosure requirement. Yes, resident needs to disclose the foreign assets, but non-resident does not require to do this. UAE, it is out and out not applicable. Next, penalty as I was discussing previously. If resident fails to disclose a foreign asset in income tax return in India, penalty is 10 lakhs. It doesn't matter that asset is just here for investment, you're not generating any income because income tax is basically an income. But it doesn't matter. The rule says that if you have a asset doesn't mean only property, it means bank account as well. Bank account is also a asset. So asset penalty is 10 lakh. Small bank accounts are exception. That is, bank account if aggregate balance does not exceed 5 lakh Indian rupees, almost 20,000 dirhams. Below, you have a bank account, a non-resident bank account, and if you don't disclose, it is okay. So I have my few friends, I think they have joined as well. They help people in opening non-resident bank accounts. So this is very important for them that if you are opening a non-resident bank account, guide your client that you need to disclose this in your Indian income tax return. It is very important. Next, what happens if you are not disclosing? What happens is penalties and fines and even imprisonment. Let's understand that. Undisclosed foreign asset is taxed at 30%. For an example, you have foreign asset of 2 CR in UAE. 2 CR means 2 crore in UAE, Indian rupees I am talking about, and you have not declared it in India. Directly 30% is taxable. Then 90% is taxable additional penalty. It means 120% of the value is already taxable. So imagine more than what you have invested gets taxable. What happens if you fail to furnish foreign asset details? The rule says it can be imprisonment of 6 months to 7 years plus fine. Willful attempt means if you say that you are not aware of the law and then you are disclosing and disclosing everything and paying the tax and penalty. Indian authorities, FEMA authorities might uh, let you go. But it's a willful attempt. It is proven thing that you are doing it purposefully. Then there is an imprisonment of 3 years to 10 years plus fine. Next, this is ODI. ODI is called Overseas Direct Investment. As I was discussing that how big investment comes over here. Big investment usually come over here through ODI, which is also permitted by RBI with special permission. RBI is Reserve Bank of India. Next, who can do ODI? What is Overseas Direct Investment? Overseas direct investment refers to investment made by Indian entity or residential individual in a foreign company or business resulting in ownership or control. Example, Indian company setting up a subsidiary in Dubai, Indian entrepreneur acquiring shares in foreign startup, Indian business opening a joint venture abroad. Now, this is as per the law which we have written, but you need to understand once we use the word individual and resident, LRS and TCS will be applicable. Once we use the word company, means Indian company opening a company over here, ODI will be applicable, which is overseas direct investment. So individual always LRS TCS route $250,000 route. Company ODI how much you can invest? It depends on company's net worth in India. So company's net worth in India is for an example 5 million. $5 million, they can invest $20 million in other jurisdictions. This is the rule. Next, who can make overseas direct investment? Indian companies, limited liability partnerships in India. They can invest in foreign joint venture or wholly owned subsidiary companies. Now, and I said Indian companies, limited liability partnership up to 400% of Indian entities net worth. So, for an example, your net worth in India is $5 million. You can invest $20 million. Means, as per the ODI route, Indian government will allow you $20 million to move from India to UAE if your company is in UAE. Now, as I was saying about this, how big people move the money. See, they already have the companies functioning in UAE, Singapore, Mauritius. So usually, if they want to move the money from India to UAE, they can directly do through ODI as per their net worth. This is how big players move the money. But because they already have the presence in others jurisdiction, what happens is they take money over there. They have the funds reserve and surplus even outside India as well, because it's a global company. So what happens is it becomes easy for them to move funds to UAE and then directly invest, because this is the major question which comes to many of people mind, that how this is happening, how this is happening. This is happens due to this, and I'm giving you the insight about it. Next, what happens, what we need to report according to ODI. Reporting of ODI through Form FC to Reserve Bank of India. We need to report, a company needs to report to Reserve Bank of India. Then company needs to file the annual performance report for foreign entity, means the company is opened over here, whatever investments you have opened over here, you need to declare that in the income tax return of that company, because you are a company. This is related to more of investment in companies, which is a ODI route. And disclosure of foreign assets, we already discussed. If an Indian tax resident or Indian tax resident company, they need to disclose the foreign assets in Indian income tax return. Next. Now, this is very important that many people don't know, and many of you are selling property saying that, sir, you have to invest only 40%, 50% rest. Non-residents get you can say a 50% loan in UAE. But suppose your client is an Indian tax resident. As per the rule, an Indian tax resident cannot borrow from foreign jurisdiction. It is a violation of FEMA. You can see under in Foreign Exchange Management Act. Many of you doesn't know this rule. Issued by reserve resident individual is allowed to acquire immovable property outside India. It means that as an Indian resident, you are allowed to acquire a property outside India. However, borrowing fund against such property is generally not permitted unless specifically allowed under FEMA rules. Resident individuals cannot freely raise loans from foreign lenders by mortgaging overseas property, as it may amount to external borrowing by a resident, which is restricted. So the law itself says it is restricted. So once it is restricted, and if you do this, UAE banks will allow. UAE banks will give the loan. But what will happen when Indian authorities come to know you have done everything legally, every investment, every single penny invested in UAE was legal. The remaining amount, because you told your client that, sir, you can take loan, he took a loan. Banks will also give loan based on the Indian income tax returns, or based on the Indian accounts, on based on net worth. Bank gives loan on the property, it's loan against property. They give it over here. UAE banks give the loan. But what happens is there's a FEMA violation. What happens? You did everything legal, but one thing you didn't do is that you didn't follow the FEMA law of not taking a loan, borrowing. So this is what it is that you need to take care while guiding your Indian clients. Next, still people are taking loan, market is running, but when ED, Enforcement Directorate, or CBI, who governs under the FEMA, they come to know, they can penalize you. A resident Indian purchases an apartment in Dubai through LRS and later mortgages the property to obtain a loan from UAE Bank. A residential individual pledges overseas property to raise funds for business or investment purpose. Such borrowing arrangements are generally not permissible without approval from RBI. It means that you can, but you have to take permission from RBI. Once you take the permission from RBI, it is okay. But usually you don't get the approval. Telling you the practical thing. Usually it's very difficult to get the approval, but if you get the approval, it is okay. Next, what happens if this is the non-compliance which we were talking about? Penalty up to the three times amount involved in the contravention, or up to 2 lakh if amount cannot be quantified. Means penalty can be up to three times of the amount involved, means you can say a loan amount. Continuing this, additional penalty of 5,000 Indian rupees per day. But what happens is, because this is the rules which many of the people don't know, what happens is that Indian authorities also understand that it was done by mistake. So you go to the RBI and tell them that please regularize this violation. I have done it by mistake. Whatever penalty or tax, compound it and give me relief. They give the relief. They tell you to pay the penalty. You pay the penalty, and then they give you the permission. It becomes regularized. What happens is that who reports, and how does RBI come to know that you have taken a loan over here? It basically data sharing, banks report it, authorized dealers report it. It's a reporting standard which many countries follow of data sharing, and due to that, they come to know. Next. Mm. So this is all what we have, and we would be taking question answers very shortly. Thank you all for attending and listening to it patiently. Let's see uh, if we have any questions over here. You can put your Q&A questions in question box. You can put it in chat as well, but it's better that you put it in question box. That's good. If you have any questions, you can ask me. I want to understand the FEMA rule for mortgage abroad. Again, please explain in brief. Yeah. So what happens is that, for an example, your client is Indian tax resident, means it stays in India. He is an Indian tax resident filing returns XYZ in India. all the income is taxable in India. What happens is he is buying a property in UAE. Usually in off plan, what happens is that 50-50 of payment plan, 60-40. And usually once the client pays 60%, and then you tell them that you get a loan. They get a loan. UAE bank allows the loan based on the property because they have the property to mortgage, they allow. But Indian rule says that you are not allowed to do this. You can invest in property, but you cannot take loan on the property. You cannot borrow funds from foreign banks. So how can you borrow funds from foreign banks then? For borrowing funds from foreign banks, you need to take a RBI permission. That is Reserve Bank of India permission that this is my property. And if you don't do this, you are not FEMA compliant and you are risking your client, or your client is risking himself for FEMA penalties, which we already discussed. So this is the rule. You need to go to RBI and take a permission, and usually it takes time to take a permission from RBI. So many of them are taking loan, many of them have taken loan. This is how the market is running. But once it comes under the scrutiny of authorities, they would be definitely giving you a penalty, or penal consequences will be taken. Any other question? So we have one more question. It says that residential status, uh, how can we determine the residential status as you explained? See, determining residential status is, you can say, a very very technical thing. And we being chartered accountants, we are learning this from Indian Income Tax Act and everything. We gave you a knowledge that basically you need to know the rule of 182 days and all. But if the situation is complex, you don't need to determine the residential status yourself. Your client also doesn't need to determine it themselves. Go to an expert. Just for basic knowledge, we have said, sir, whether you stay in more than 182 days in India or not, yes or no, this is the answer. But for taxation advisory, for exposure, you need to go to the expert and give him all the details, because there are many complicated cases which I handle like this. What happens is they are staying in Dubai, they are staying in India, they don't know how many days they have stayed in India, how many days they have stayed in UAE. This complicated cases come. So usually, you being a real estate consultant, you can just tell them that, sir, this is what I feel. You can hold the conversation, but before taking any decision, go to expert. That is a very very important thing. One more question. Yes, Murtuza bhai, I'll explain you this. Can you please repeat and clarify the rules for a NRI to bring personal funds from India to UAE? Yes. For an example, very good question, Mr. Murtuza. A non-resident Indian means the person is staying in Dubai, let's see. They have sold the land in India and now they want to move the money over here. Okay. What happens is it can be done easily. What you need to do is, because you have sold the land in India, even if it's an ancestral property, there would be a capital gain tax in India. You need to pay the capital gain tax on the gain on the property. It's like 12.5% of the gains you need to pay. Remaining amount, it comes in NRO account, that is non-resident ordinary account. From there, you can transfer it to NRE, non-resident external account. And once it comes to NRE, it can come to your UAE bank account from that NRE account. So this is how it is done. You need to pay the taxes of only the Indian income generated of capital gain over there. Rest amount can be transferred over here, even if it's an ancestral property. And LRS remit doesn't apply to this kind of cases. You can transfer up to $1 million per year. Any other question from anyone? Yeah, so I got one more question. It says that my client, okay, okay. Yeah. So the client is a non-resident. Client is a non-resident, but they are having funds in India. They want to move the funds from India to UAE, and the funds are in, okay. The funds are in different bank account. It means that, for an example, your client is a non-resident, but the funds are in client's father's account. Father is a resident. What happens is, now you want to move the fund, you don't want to do the LRS. I'll give you one way out for this. Tell your client's father to give gift to your client. Make a gift deed. Gift is not taxable in India if father is giving to son, because it comes under the definition of relative. Make a gift deed, give the gift, transfer the amount from father account to NRO account, and from NRO to NRE, and from NRE to UAE bank. This is what you can do. This is a legal way. I've given you a consultancy and for free because you are attending my webinar. Yeah. So any other questions? I think we had a very insightful session, and thank you everyone for attending it and to listening it patiently. And we would be sharing you this presentation, and webinar is also recorded and link will be shared with you in few days. Okay. So thank you very much for attending, and thank you for showing trust in us. And please review. If you like this webinar, please put a word of mouth in your real estate friends, agents, that we are giving this training. We would again come up with this training. We were planning to postpone this webinar due to the situation, but then we needed to pass on the message of positiveness to ourselves as well as our subconscious mind, that we are ready for anything. That's why we continued with it. We will come up with other such kind of webinar regarding movement of money from India to UAE and basics that we have covered right now. So do tell your friends, and next time when the existing attendees would like to join, they would be given a special code so that they can join it for free of charge. If the same webinar we do for other participants, and if you want to join, you can do it for free of charge. We will be giving you a code for that. Thank you very much, and have a nice day, and be safe and be positive.